In today's episode, I'm going to share with you the strategies the top 1% of traders are using to pay zero income tax on their trading profits. This is huge. I have implemented some of the strategies I'm going to share with you in today's episode in my own trading, and I have saved literally millions of dollars in taxes. Now, it doesn't matter whether you're making $25,000 a year, $50,000 a year, $100,000 a year, or you're making millions of dollars a year in trading profits. There are steps that you can take to reduce the amount of taxes that you're paying. And not only are these legal, they're encouraged. There are systems and strategies that have been set up that regular Americans are supposed to be using that allows you to put aside some of your income totally tax-free so you can reinvest that long-term in your retirement in the form of supporting the economy, buying stocks, bonds, and real estate. If you're not doing any of this, you're missing out. So let's get with the program and let me walk you through these strategies. Now, what I'll share with you, first of all, is that as many of you know, I turned an account with less than $600 into more than $10 million of verified and independently audited trading profits. And when I did that, naturally, I had to hire a pretty good accountant to file my taxes. Now, it's not really that it was all that complicated, but I want to make sure I was doing everything the right way and I had the money to afford it. So some of the things that I'm going to be sharing with you came from high-paid accountants who know everything about how to be as tax efficient as possible. So the first thing I learned, and this is the strategy I'll share with you, it's the first strategy. It's not going to be the most popular. I'm going to save the most popular one for last. But the first strategy that was shared with me is my accountant said, Ross, how do you feel about moving to Puerto Rico? And I said, well, that's not going to work so well because, my family lives around here, but tell me more. And he said, well, here's the thing with living in Puerto Rico. There's no short-term capital gains tax. You would literally have zero income tax on your trading profits. And that means if you make 100,000, you make $1 million, whatever it is, you could spend that right away and you don't pay any income tax on it. And I said, well, geez, wouldn't that mean I'm no longer a U.S. citizen? And he said, no, it's not like that. If you move to Puerto Rico, you're still a U.S. resident because Puerto Rico is part of the United States. But if you're a Puerto Rican resident, which means you live there for 6 months and 1 day each year, then you pay no federal income tax and you're able to benefit from all of the tax savings that Puerto Rican residents enjoy. That's why so many very wealthy people move to Puerto Rico and spend 6 months and 1 day there. And they have to make sure they document each one of those days that they're there, because if they ever get audited, they want to be able to prove, no, I'm really a Puerto Rican resident. So most of the people that are down there for tax benefits are saving so much money in tax that the savings alone is enough to pay for the mortgage of a property, of a house. Now, that's not going to be the typical trader. It wasn't me when I was getting started, although it probably could be me today. The life change of moving to Puerto Rico isn't something that makes that strategy doable for me. But an episode on how to pay zero income tax on your trading profits would be incomplete if we didn't at least mention the option of moving to Puerto Rico. So if you move to Puerto Rico, you could live there, and at any time, you can move back to one of the 50 states in the US, and it's no big deal. You can just move, you switch states just like you move from New York to Massachusetts or from New York to California. So that's the first strategy. Move to Puerto Rico. Some of you guys are like, sold, I'm moving, I want to live near the beach, and that's great. But for the rest of you, let's talk about the second strategy. So the second strategy is to take advantage of what are called tax-deferred retirement accounts, which are traditionally called individual retirement accounts, and the abbreviation is the IRA. Okay, so an IRA is an account that anyone in the United States can open. In a lot of other countries, you have government-sponsored retirement savings accounts as well that you can utilize to invest in the market, but I'll speak specifically to what I know, which is being here in the United States. So in the US, we have the IRA. Now, you can make contributions to an IRA each year, but there are limits to how much you can contribute. Now, the cool thing about the IRA, an individual retirement account, is all of the growth inside that account. However much that account grows each year, you don't pay any income tax on it. And you can actively trade in an IRA. Now, bear with me for a second. This is really incredible. If you set up a business as a small business, whatever, you're a plumber, you're an electrician, or you mow lawns, or you plow, all of the money that you earn in that business, while you can do some things, which we'll talk about a little bit later in this episode, to create a retirement account for the business, most people won't do that. And most people are not going to be able to save all of that money that they're earning through a retirement account. They're just going to end up paying tax on it. But as a trader, every day that you're trading, you can sit down and you could be trading just in a retirement account, which allows you to grow this account at what is really an incredible rate. So here's the way it works. When I turn that $600 in the first year, I started with $583 in year one, $583.15. By the end of that first year, the account had grown to $335,000, which was huge. And out of that, I was allowed to make a maximum contribution of $6,000 to a traditional IRA. Now, a traditional IRA, and this is probably the most common IRA in the United States, the cool thing about traditional IRA, and the reason that a lot of people like it, is that when you make a contribution to a traditional IRA, the amount that you contribute comes off of your total taxable income. So let's just say, for instance, your taxable income was $100,000. You do a $6,000 IRA contribution. Now your taxable income is $94,000. So it saves you a little bit of tax. But the problem with doing that is that then when you eventually take a distribution from your IRA, which you can start doing at 59 and a half years old, all of the distributions are taxable. And that's a little bit of a problem, because if you've grown this account from 6,000 up to 10, 12, 15, then up to maybe 50,000, 100,000, 200,000, up to $1 million, then you're going to pay income tax on $1 million when you're 59 and a half years old and you're taking out those distributions. Now, the theory behind this is that by the time you're at retirement age, you'll probably be at a lower income bracket. But that's not always the case. Sometimes by the time you're at retirement age, you've made so much in your account and your cost of living has gone up that you're still in a very high tax bracket. So in the US, we have two different types of IRAs. We have the traditional IRA and we have the Roth IRA. So we have the traditional IRA here and we have the Roth IRA here. Now, the Roth IRA has a maximum income limit of $153,000 per year, which means if you make more than $153,000, you're not allowed to contribute to a Roth IRA. Why is that? Well, a Roth IRA does something kind of special. A Roth IRA allows you to grow the account totally tax-free. And when you take the profit out at 59 and a half years old and you're taking distributions, those are also completely tax-free. Whoa. Okay, so a Roth IRA is definitely better than a traditional IRA. No question about it. But wait, shoot, there's a maximum income of $153,000. Clearly, I made $335,000 in this first year of trading. That's right. And that's why we have something called the backdoor conversion. This makes no sense. I mean, you guys, it goes without saying that our tax code is incredibly complicated, but what we have in the United States is the backdoor conversion. And this very silly thing that exists allows you to make a $6,000 contribution to a traditional IRA where there are no income limits. And then you can convert a traditional IRA at any time to a Roth IRA. You just do a conversion. And they call it a backdoor conversion because it allows you to get around this maximum income, or the maximum income of $153,000. So when you do the conversion, remember how I said that $6,000 comes off your taxable income? Well, when you do the conversion, you have to pay income tax on the amount you convert. Okay, no big deal. So I paid income tax on $6,000 and I converted it into a Roth IRA. And that gave me, with year one, $6,000 in my Roth IRA. $6,000 at year one. Now, in year two, this was year one of the small account. In year two, I produced $498,000 of profit. I contributed another $6,000 to a traditional and then converted it to a Roth. In year three, I made about $365,000 and I did it again. $6,000 contributed into a traditional, converted it into a Roth, which left me with $18,000 in a Roth IRA. With $18,000, at that point, I decided to begin trading with it because what my accountant said is, he said, Ross, if you trade in the Roth IRA, you're not going to have any income tax. And here's the thing, you're making more money trading than you need. So if you're making more money than your cost of living, what do you do? And for me, I wasn't going to stop trading. I wasn't going to trade less. But the result was that when I was making $500,000, I was making more than my cost of living. So if my cost of living, and let's just say for the sake of argument, my cost of living is $10,000 a month. So cost of living, $10,000 a month, all right? That means I need $120,000 a year to cover my cost of living. So once I've made the first $120,000 each year, I'm good in terms of taxable income. Now this $120,000, I'm going to pay income tax on it, but I'll be able to spend it for my cost of living. So once I cross over $120,000 in income to cover cost of living, everything from that point forward, I can start using my IRA for. So that's what I did. And what I ended up doing was turning an $18,000 Roth IRA into over $6 million. Now, that sounds like a lot, and it is, but for what it's worth, there's a fellow, Peter Thiel. He was an early investor in PayPal and an early investor in Facebook. He took a $2,000 Roth IRA and turned it into $5 billion. This is insane. $5 billion. He may have the record set on the biggest Roth IRA. That's totally tax-free income, totally tax-free when he retires, and now it's allowed to keep growing and growing and growing. So obviously there's been some criticism over how the Roth IRA is used by some extremely wealthy people to put away a lot of money totally tax-free. And certainly I use the Roth IRA to put away money tax-free to the tune of millions of dollars. And you can do it as well. Now you may say, look, I got to first cover my cost of living. Okay, so this is what I would do if I were you. I would say, all right, you've got your cost of living right here. Make the minimum amount you need for cost of living and then trade in the Roth IRA. Now, what you could do is you could have two accounts and you could switch during the day. Let's say each day you trade until you make your first $500 in a traditional account. And then once you've made $500, you switch the rest of the day and trade in the Roth IRA. Or you could trade just one day a week in the Roth IRA, Fridays, whatever day it is. It doesn't matter how you do it, but in a way, to me, it's a no-brainer not to do it. As long as you can put aside enough money just to start the Roth IRA, you could start trading in it. And so one of the things that I do is I can actually trade in both of my accounts at the same time. I can switch back and forth very easily. I press the buy button in my Roth, I press the buy button in my main account. So I could take basically the same trade in two accounts if I want. I just have to press the buy button twice. And I'll do that all the time. Now, is it initially a little more difficult to trade in two accounts? Yes, but we're talking about a huge tax savings. And to me, it's a no-brainer. Okay, so the second strategy, and this is to me a no-brainer, is to create a Roth IRA. Create it for yourself. Now, the nice thing about a Roth IRA is that there are no minimum distributions. You are not required to take distributions. You can pass the whole account in part of your estate planning to someone else, your children perhaps, unlike a 401k. Now, in the United States, these are the two sort of tax deferred accounts that we have, IRAs and 401ks. So let's talk about strategy number 3. The third strategy is to start trading in a business account. Now, this is where things get a little bit more complicated, but accountants love this. And the reason they love it and the reason they'll encourage it is because it can allow you to do some really incredible things. Okay, so let's say you're making a little bit of money each year trading, and you're doing relatively well. Again, doesn't matter. It's all relative. Doesn't matter if you're making $50,000 a year, you're making $250,000 a year. You're making money. Let's just call it $100,000 a year in trading profits. All right, so you've got $100,000 a year. Now, if you had that $100,000 a year in a traditional taxable account, you're going to pay income tax on $100,000, and that's at short-term capital gains tax rate, which is the same as your income bracket. So you're going to pay as if you have W-2 wages at $100,000. Now, one of the things that's nice is that $100,000 of income from trading is not the same as $100,000 of income from a W-2, because trading income is not considered earned income, so you don't have to pay self-employment tax, which means you're not paying Medicare or Social Security. So you save a little bit, but you still would pay income tax on it. Okay, so let's say you've been doing this for a couple years, you're making money consistently, and you're thinking, all right, how do I pay less in tax. So what you could do, and this is what a lot of people do, is they'll create a corporation, and they'll specifically create a corporation with S status election. This means all of the income tax will pass through to your personal tax return. It's not a C corp that files its own tax return and pays its own income tax. It's an S corp. Now, with an S corp, you're going to be an employee of the S corp. And so you have to take a W-2 of what's called a reasonable salary. Now, you should have a tax attorney or an accountant give you a recommendation of what the proper reasonable salary would be relative to the income that the business is producing. But let's just say the company is producing $100,000 a year, and let's just say you have some expenses associated with the business. So what are some expenses associated with it? Laptop? Maybe your desk? Maybe the percentage of home office space that you're using, right? Because you've got how many square feet, let's just say how many square feet of your home office are you using? Maybe your home office is 10% of the square footage of your entire house. Well, 10% of the utility bill, 10% of the of really all of the utility bills, 10% of the internet bill, all of those can be factored in for your expenses associated with the business. So now you take your percentage here, you add all those up. You've got maybe some other equipment you use for trading. You've got some dues. You've got some subscriptions, different services. You've got your continuing education services, right? So education, courses, things like that. So you've got your courses, whatever it is. So you've got all these different things that you've got in your S corp. So let's say this reduces, these are expenses and they total out to, let's just say $15,000 a year. And there'll be people that try to push the percentage. You've just got to make sure it's reasonable and make sure you have an accountant that reviews it and feels good about it. So you're taking, let's say $15,000. So now you've got your 100 grand and you're taking $15,000 off the top for expenses. All right, so you've got your expenses. Now you've got $85,000 left. Let's say you pay yourself a salary of $50,000. So you take a W-2 salary of $50,000. Now you can do something kind of interesting here. You can set up a solo 401k. A solo 401k with the company is the same as a 401k that you would have with an employer, except you're the only employee. And so you may decide that you want to also pay out a percentage of company profits as a match to the 401k. And this is what a lot of people will do. So let's actually change this number for a second. So let's change it to, you're going to do a $40,000 salary. Let's just put it at that for a second. Okay. So of the $40,000 salary, $23,000 each year can go directly into a solo 401k. So that's your solo 401k. And remember, when you do a traditional 401k, that's going to reduce your income down to $17,000. So you'd actually only be paying income tax on your W-2 on $17,000 because of the $23,000 going into the 401k. But the company still has, $40,000 left in profit. So the company can actually do a match of profit share into the 401k, and they can go up to $69,000 per year total comp between your own contributions and the company match. $69,000 a year could be going into a 401k. Now, look, you still need to make a certain amount of money just to cover your cost of living. But one thing that I've learned over my years is that the wealthiest people not only stay wealthy, but they get even wealthier by being frugal, especially early in their careers. I have a neighbor who passed away in his 90s, but he worked as a janitor and he worked at a gas station as an auto mechanic. And for his whole life, basically, he had those two jobs. And he ended up amassing a fortune of over $8 million. Even though he never had a fancy six-figure salary or anything like that, he was frugal. A penny saved is a dollar earned. And he put that money away, he put it away, and it grew and it grew and it grew and it grew. Now, a lot of times people who are young and come into a little bit of money, they spend it very quickly. They want to keep up with appearances, keep up with the Joneses, the Kardashians, you know what I mean? They want to keep up, look very wealthy, and they spend all that money and it's gone. So the less you can live on, the more you can put away, because the money that you need for your cost of living, that's taxable. You're going to pay income tax on that. So this is a strategy that a lot of people will use. And is it a little bit more complicated? It is. Is it going to be something you'll do if you're making only 70,000 a year? I don't know. 50,000? Probably not. 20,000? No. Over 100,000? Well, now it's just a cost benefit analysis. How much am I paying in tax? How much would it cost to have an accountant set this up for me? Because once it's set up once, it's done. And then you just fund it each year. And the nice thing now is that you've got a solo 401k and you can use that for investing. And you can invest in not just in the stock market, you can invest it in real estate and in all sorts of things. So if you are a trader and you have some degree of success and you're trading in your personal name, it's really worth spending a little bit of time getting some advice from an accountant to figure out if it would make more sense to trade in an S Corp. Now, regardless of whether you're trading in an S Corp or you're trading in your personal name, if you have not done mark-to-market election for your taxes, you could be subject to wash sales. So a wash sale is when you take a loss and within 30 days, you buy back a position that is more or less similar or the same. In the older days, what people used to do is on December 30th or whatever, 31st, they would sell all the positions they were holding at a loss. So their statements would show these big losses, and then they would just buy back the same position on January 1st. So they would book the loss, and then they would buy it back on January 1st. And the IRS was like, no. You can't do that. So that would be called a wash sale, to sell and then buy back. The problem is, as a trader, we're often buying and selling the same stock all the time. We're getting in, we're getting out, we're getting in, we're getting out. And so sometimes traders will get subject to seeing a wash sale, which means you'll have some losses that you're not allowed to write off. And the problem is, in that tax year, you have to wait for the next tax year. And the problem is that's going to make your income tax higher than what you actually made. So it's very important to do mark-to-market status election on your return. And you have to do it by April 15th of the current tax year in order for it to work for that tax year. So you can't do it I can't do it right now for last year. It's too late. You have to do it before April 15th of the current tax year in order for it to apply. So that's something that's really important. Now, by the way, in this scenario right here, this $40,000 is a tax deduction for the S Corp. So they deduct your payroll, they deduct the profit share. And so in total, the S Corp has zero income because we balanced out to zero, right? We have 40, 40, 15. So we balanced out to zero. So we actually are 5,000. So let's just make it 20, whatever. So you balance out to zero. So the business actually produces no income, and the only income that you had was the $17,000 in wages. Now, again, $17,000, okay, maybe that's a little extreme. That's not going to be enough to live off of for everyone, but depending on where you're at, maybe it is. And if it were, then you're still saving $69,000 each year in the 401k, and you're using the company to pay for some of your business expenses. And this is something that a lot of traders don't even think of. They're just trading from their home office and they're like, oh, no, it doesn't matter. I didn't even think of that. And, that's all fine and well. But at the end of the year, how much are you paying for that office space? How much are you paying for your equipment, for your computers? How many monitors do I have here? How many laptops do I have here? Right? All of this stuff is part of the cost of running a business as a trader. Something that I shared with all of my students at Warrior Trading is that I had a goal early on in my career, and this was after some advice from some really great accountants. It was that I'm going to focus on trading as much as I can in my tax-free account. And what I want to do is I want to grow that account as much as possible, because I know that if I grow it to 8 to 10 to $15 million, I'll get to a point where that money invested in the market or invested in real estate, invested in other things, has the potential to earn more each year than I could ever make actively trading. Now, in my best year, I made over $5 million actively trading. So realistically, I would have to grow this account to like $50 million for 10% to be $5 million. That isn't going to happen anytime soon. That might probably never happen. But I think the point is there are going to be some years that are going to be really great, like that year was. And then there'll be other years that are a little slower where I might make $500,000. That's totally within the realm of reasonable that I could have that type of flux between years that are hot and years that are cold. And so on a year where I make $500,000, well, now $10 million that produces 10%, 12% return, that's $1.2 million a year. and it's growing tax-free, which allows that interest to continue to compound, and it gets bigger and bigger and bigger and bigger. So I really think the sooner you start putting some money into these tax-deferred accounts, the better. Whether you're going to use a solo 401k, you're going to set up a business, you're just going to do a typical Roth IRA, or, well, if you want to move to Puerto Rico, move to Puerto Rico. But there are strategies that are right in front of you that so many people are utilizing, and certainly the top 1% are using them to pay almost nothing on their trading profits. I encourage you to take a deeper look at the way you're allocating, what accounts you're trading in, and how much you're paying in tax. And as always, reach out to a CPA and get some really good advice, because a good CPA is worth their weight in gold. I hope you found this episode helpful. I hope you hit the thumbs up. I hope you subscribe to the channel, and I'll see you for the next upload real soon.